welcome back to this week's market update. Today is Monday, April 20th, 2026, and we'll jump right in. Looking at last week's market performance, equities advanced sharply as easing geopolitical tensions, including improved energy flows through the Strait of Hormuz and strong corporate earnings boosted risk assets. As of Friday's close, the Nasdaq Composite led with more than a 6.8% gain, followed by the S&P 500 up 4.5%, and the Dow up 3.2%, with both the Nasdaq and the S&P 500 touching new all-time highs. Moving into our economic data, it was a lighter week of data, but nonetheless still some important updates we want to take a look at. First off, we had wholesale prices come in less than expected for the month of March, with headline PPI rising to 4% annually, core PPI at 3.6%, which excludes food, energy, and trade services. On a monthly basis, headline prices were up just 0.5%, which was much better than the 1.5% that was expected, and core prices were up just 0.2%. So this really signals that the source of this increase in wholesale inflation to 4% has been highly concentrated in energy. So looking at that more specifically, energy prices were up 8.5% in the single month of March here. Other categories like foods, they were actually down 0.3% in the month, and services were flat for the month of March. Although inflation remains elevated, the softer than expected report was viewed positively by markets as it suggested that nearly all of the recent inflation acceleration has been concentrated in energy. With improving clarity around conditions in the Strait of Hormuz, energy prices stabilized over the past week as geopolitical risks eased. U.S. gasoline prices declined about 2% last week, falling from a national average of $4.15 to now closer to $4.07 as of Friday, though they remain up about 7.5% from a month ago. Similarly, WTI crude futures moved from above $100 per barrel at the start of last week to closer to $84 per barrel by Friday afternoon. Now, they are back on the rise on Monday morning here. We'll have to continue monitoring, but it is a good sign to see energy prices start to stabilize. We also got existing home sales data for the month of March, showing that real estate activity continued to moderate last month as interest rates picked up. Existing home sales declined 3.6% on the month and were 1% lower than the same period last year, while inventory continued to creep up, with homes for sale rising 3% in the month, up 2.3% from a year ago. This led the months of supply to also increase up to 4.1 months of supply. This was a bit higher than last month and just ever so slightly higher than the same period last year. Last but not least, we also had the median sales price come in 1.4% higher than a year ago to $408,800. These trends reflect a gradual normalization from the unusually strong post-pandemic residential real estate cycle. So it's not necessarily that we're seeing a real estate downturn, it's more so a period of normalization and settling down from a really hot market. Now, it was a quieter week for economic data, but not for earnings. We had Q1 earnings start on a really strong note with nearly 50 companies in the S&P 500, so about 10% of the index already having reported results so far. These companies have posted approximately 34% EPS growth from a year ago, while the remainder of the index is expected to deliver closer to 9 to 10% EPS growth. So another strong quarter for the index, blended to about a 13.4% expectation for earnings growth in the first quarter. Financials led in early results. You can see of the 24% of those companies that have reported, EPS was up 20.3% from a year ago. Technology also has really high expectations for the first quarter, with the 5 companies that reported last week, their earnings up 150% from a year ago. The overall sector having earnings expected to grow 45% from a year ago. Now, it does remain fairly early in the earnings season, but we want to take a look at how the next 2 weeks will be really vital to market sentiment as well as the corporate fundamental backdrop. Even with it being a very strong start to the earnings season, the next 2 weeks will be crucial to the direction of market sentiment and the corporate backdrop for further market expansion. Here you can see this week ahead is a bit of a slower week, but still important. We have GE Aerospace, United Health Group, so that'll be pretty big for the healthcare sector. Tesla, Intel, American Express Company, they will have some really good insights on consumer spending and the health of the consumer. Procter and Gamble showing us some insights into consumer staples, as well as Verizon next week, Visa, Coca-Cola, and then this is when it gets really influential for the market next Wednesday and Thursday. So in about a week and a half here, we'll have all of the major tech companies report in just about a 48-hour period. So we'll start off with Alphabet, Microsoft, Amazon, and Meta on Wednesday, April 29th, then switch into Apple. And then we'll get results from Eli Lilly, Berkshire Hathaway, and then the major energy giants, ExxonMobil and Chevron, which should give us some interesting insights into how the Middle Eastern conflict has affected domestic energy companies. Overall, earnings will be a really critical factor for markets in the upcoming weeks, with potential to send the markets to even further highs or the potential to cause another sell-off. So very important stuff we want to follow in the upcoming 2 weeks for earnings. That concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.